This chapter marks the transition from talking about financial markets to financial institutions. And with that, we need to at least start with an analysis of the financial structure itself. What does the system look like, and what is it trying to do? Now, we've already looked at this back all the way back in the introduction. From that, we had the discussion that any developed economy requires a financial system. Really, until the United States had such a system, it was a developing country. And it really only got that system after the Civil War, and really truly only after the Federal Reserve was established in 1913. And even more so after during the Great Depression, when you really start to see the regulatory structure growing. So what we need in the financial system is a way for individuals to save money, and another way for individuals to access money when they need it for borrowing purposes. You need this because the key to economic growth is growth in capital. And you can't grow capital without being able to borrow money. Now, what we're going to do in this chapter, what a lot of this chapter actually focuses on, are these 8 facts about the global economic system. And we'll talk about each of those extensively. And then we're going to talk about some of the information problems that exist in the financial system, which is what gives rise to financial institutions like banks existing. So, to look at this, it's useful to see how are businesses actually financing their money. Where's the money coming from? And so we do this kind of analysis by comparing the United States to Germany, Japan, and Canada. Now, I want to talk about a few things in this chart. This chart's pretty important here. One thing we see here is that the United States is pretty well distributed across the 4 categories: bank loans, non-bank loans, bonds, and stock offerings, with the heaviest reliance on non-bank loans and bonds. So this is how we're saying, this is how businesses in these 4 countries, how do they get their money? So this would mean that in the United States, banks primarily get their money by either issuing bonds or, more likely, getting loans from non-bank institutions. So this would be like private offering bonds issued to hedge funds, direct loans, or other kinds of business arrangements with capital institutions of some kind, or getting a loan directly from a bank. That would be kind of like a line of credit. And what you'll notice is that most businesses are not really accessing money by issuing stock. Only 11%. And what distinguishes the United States from Germany, Japan, and Canada is that in Germany, Japan, and Canada, most of the money is acquired through bank loans. Now, by doing that, One of the reasons why Germany, Japan, and Canada, why so much is reliant on bank loans, is that those are three countries where the savings rate is quite high and where the banks have a lot of money to lend out. That's not necessarily the case in the United States, where, generally speaking, the reserves are a bit lower. What you're also seeing here is that, now for the most part, that you're seeing, again, a pretty good distribution. If anything, it's a binomial distribution in the United States for how they get their money. You basically have non-bank loans and bonds as the majority, where the majority of the money coming from, and then bank loans and stock offering as the remainder. Now, let's talk about, let me just kind of state these 8 facts, elaborate them on a little bit, but a great deal of the rest of these slides is actually going to be referring back to these 8 facts. So you want to refer back to slides 7 and 8 repeatedly. 1. Something that I already stated. The first fact about the financial structure in the world, the global financial structure, is that stocks are not an important source of funds. And we can just see that in the previous slide. 2. Issuing marketable debt and equity securities is not the primary way that businesses finance their operations. That would mean, again, bonds and stocks. So even bonds and stocks together are not the primary way. Indirect finance is many times more important than direct finance. How do we separate this out? Bank loans and non-bank loans would be indirect finance. Bonds and stocks would be direct finance. Direct finance, because a bond is simply a business offering a bond to investors. A business issuing stock that is purchased by investors. Whereas a bank loan and a non-bank loan has an intermediary institution, be it a bank or a non-bank, that basically reviews what the request for money is, puts in place certain safeguards, and it's an intermediary that helps the borrower get the money, but it also helps the person who's saving that wants to invest their own money be protected in finding an opportunity about how to invest their money. Fact number 4, financial intermediaries, particularly banks, and this would be, and particularly not in the United States, are the most important source of external funds. The reason for this, again, would be in that most developed countries in the world, their banking systems have a lot of excess reserves. Fact number 5, which is not going to be evident from what we just saw, the financial system is one of the most heavily regulated sectors of the economy. Fact 6, only large, well-established corporations have easy access to the securities markets. We'll see why that's the case here shortly. Fact 7, collateral is a prevalent feature of debt contracts for households and businesses. And fact number 8, debt contracts are complicated legal documents that have restrictive covenants on borrowers. We will see how that's the case as well here. Now, one of the things that we see here is that in indirect finance, again, we have these financial intermediaries. Now what they're doing is that they're evolving over time, getting larger, putting in place better technology, putting in place better employee training. They're just doing a number of things to lower their transaction costs. By getting larger, there's a lot of fixed costs to lending out money. And by getting larger, those fixed costs are spread out across more lenders, borrowers. And by being larger, you gain more expertise. You can specialize more. And that's all going to reduce the cost of lending out money. But as we saw with one of the previous facts, indirect finance is more important than direct finance. Why that's the case has a lot to do with the fact that whenever you're borrowing money, the lender is faced with a challenge. That challenge being asymmetric information. Asymmetric information means that the parties have a different level of information. And two things that we see here would be adverse selection and moral hazard. Adverse selection is an asymmetric information problem that occurs before the transaction. So an example of that would be if I am a risky person, let's say I like to drive fast, then I know that I like to drive fast, but let's just say I've never been caught driving fast. I've never gotten a speeding ticket. Then if I love to drive fast, but I've never been caught, I'm going to probably seek insurance. And I'm going to do that because I know I'm a fast driver and I'm obviously taking on a lot of risk. But the thing is that there's asymmetric information. Because I've never gotten a ticket, the insurance company thinks I'm a good driver. Maybe I've had no claims, no tickets. Then they might mistakenly think I've been a good driver, when that's not in fact the case. Which is why, actually, a lot of the major insurance companies offer these devices that you can they'll give you cheaper insurance if you plug a certain device into your car that tracks how fast you go, in an attempt to remove some of that asymmetric information. Moral hazard is the problem that occurs after the transaction has developed. For moral hazard, we're saying that once I have insurance, what can be done to make sure that I continue to be safe? Well, for car insurance, your policy comes due every 6 months. So even if you just start love getting in accidents, let's just say that's what gets you happy. Well, after 6 months, the insurance company is going to be like, dude, you've had 15 accidents in 6 months. We're dropping your coverage. And within economic thought, agency theory, which is a kind of a field of specialty in economic thought, it would look at how asymmetric information, that often takes the form of adverse selection and moral hazard, how moral hazard and adverse selection, how they affect our economic behavior. Another problem that emerges in asymmetric information would be what's typically called the Lemons problem. It's named after a famous research article from George Akerlof, Akerlof, a University of Chicago economist who wrote a very interesting research paper on the market for used cars. And what he found in this research is that if it is uncertain what the quality of the used good is, most people that are buying that used good are just going to think it's of average quality. But the consequence of that is that if you own something that's intact, in really great condition, you're bound to get upset because it's only going to sell for average quality. And if that's the case, if people who have a really good product are not going to want to sell their item because they know they can't get a really high price for their item, then one of the things that's going to start to happen is that buyers might not buy some things at all because they're going to get a sense that there's no real good deals out there, and that all that's going to be left in the market are really poor items. As an example of the lemons problem, my son Truman is taking piano lessons. He's been taking piano lessons for like 2 years. Or probably many of you have taken your piano lessons. Masaki School of Music. Well, it's funny, you can go onto like Craigslist for a piano and you can get a piano for like free. Usually, right, some old person died and the kids don't want the piano, so they just say, oh, maybe it needs to be retuned, but yeah, you can have this thing for free. So you've got free pianos out there that, right, are in various levels of quality, but, it's free, so what are you going to complain? And then Masaki School of Music sends out these emails that are like, from like, really rich people that, live in Honolulu and, are retiring and are now going to move to the mainland or whatever rich people do. And they're selling their piano they bought from Masaki School of Music in the early 90s. And they're like, and this ad, seriously, this is an ad I saw last week, was, we bought this in the early 90s. We paid $13,000. Price is negotiable. And my wife and I thought about that and we're like, dude, who would pay $13,000 for a piano that's now 30 years old? And the person says, oh yeah, we took great care of it. We always got it tuned. It's always been tuned by this person. But if you're buying a used piano, you're probably going to, be a little cautious. That's why whoever this person was decided to go through, did whatever they had to do to get Masaki School of Music to like send out this email to kind of have it vouch for the quality of this product. But all I can think of is the third bullet point, where I might just take the free piano and take the risk, right, of just having to pay some money to repair it and transport it. And maybe it works out, maybe it doesn't. Now, there's lots of ways that asymmetric information is resolved as well. Like in the used car market, we have Carfax. We can also for the most part, we can get credit scores on individuals. We can, as we saw in the previous chapter, we can get agency scores on bonds. We can find out what the credit health is. Government regulations can try to increase the level of information that all parties have and try to reduce asymmetric information. But one of the other ways we get through asymmetric information is by having another party intervene or intermediate, the bank. Because then what the bank does is it does its own due diligence. It hires underwriters who make sure that things are what you say they are. So a classic example of this would be like getting a mortgage for a house. When you get a mortgage, right, the bank is going to, have someone come out to the property and make sure that the title is owned by the person who's selling the house. They're going to make sure that the house is worth what the people say it's worth. They're going to make sure that the roof's not leaking. They're going to make sure that you have the down payment. They're going to make sure that the down payment's coming from your own money, not someone else's money. Banks serve that role, and they're going to charge you for serving that role. They're going to charge you closing costs. The other thing they're going to do is that while you own the house, if you have a mortgage, the bank also owns it. So if you fail to pay your loan as you should, and then you have to sell your house because you weren't paying your mortgage, well, the bank's going to get paid first. And anything left over, you'll get whatever's left over. That would be our collateral and net worth option. One of the things that, this example's a bit old, too old for probably most of you in this class who were only barely born when this happened. But you probably have heard of this company called Enron. Enron was doesn't exist anymore, but it was a energy company. Sold electricity in the wholesale market. And it went bankrupt in December of 2001. The thing is that it wasn't caused by the recession that existed in 2001 and had nothing to do with September 11th or anything like that. It's that in the years leading up to December of 2001, the business itself was slowing down, but what they were doing so that investors remained happy is they were saying they were making money when they in fact weren't. And then they hired an accounting firm, which no longer exists. But it used to be one of the 4 largest accounting firms in the United States. It was called Arthur Andersen. And Arthur Andersen, so that it could get some lucrative contracts, consulting contracts, they told their accountants, hey, just say that whatever they say is good to go. And they did. And it caused the entire accounting firm to collapse as well. Now, the reason why we're talking about this here is that accounting firm was supposed to be serving as that information source. And it now, in this incident, was no longer delivering impartial information. But also, too, what's happening here is that it created a new regulation. The failure of this corporation, the leaders of the corporation, Jeff Skilling was among the people that was running this company. He basically had this defense of, dude, I just signed stuff all the time. I had no idea that, some employee of mine was lying and saying we had all this money. I don't know. I just signed stuff. Now, there's a rule called the Sarbanes-Oxley rule, or SOX. And in that rule, a financial officer has to say, by signing this, I am saying I know what's going on and I take full responsibility for everything that's stated here. And if I'm lying to you, I go to jail. So what you see here is that companies then face a choice when they're trying to get money in the direct markets. Do we issue debt or do we issue equity? Both of these have some degree of the principal agent problem. So for instance, in equity, the principal agent problem here, if you were to issue stock, is that the shareholder is never going to know as much as people within the company know. They always are going to have less information. So, one thing that sometimes happens here is that if you are a big leader in the company, you have to disclose your what they call insider trading, where top officials within the firm have to say, hey, I'm selling my shares. And that's supposed to give some more information to shareholders. We also have other regulations, like all companies that issue stock have to give an annual report. They have to issue a 10K, an 8K. They have to issue different financial reports. For bonds, you also have a prospectus for the bond offering, and usually there's going to be some collateral there that's going to back up that that bond. But a part of the problem as well is that people within a company, if they're not the shareholders as well, or they have no stake in the company doing well, they might not work as hard. So that's what this last bullet point, the second bullet point, is highlighting here, is that there's often, you want to try to reduce the separation of ownership and control within the firm. You want to make the managers and employees also shareholders. So they act in the best interests of the shareholders. And thus it helps everyone. So that would be why many large corporations offer stock to their employees. I've already said a great deal about most of these here, so I'm going to skip these. These referring to Fact 1, Fact 5, Fact 3, Fact 1. That's referring back to the facts about the financial structure. Monitoring is important, and this would be why stocks are generally not used as much. Government regulation increasing information. This is why, generally speaking, we see something working well about the financial system. Financial intermediation. This would be the reason why we see that non-bank loans and bank loans are used more than debt and stock offerings. The importance of debt contracts explains why stocks, again, are not used that much. So, when we look at borrowers and lenders, there is a moral hazard. What are you going to do with the money once the bank gives you the loan? Borrowers like to take on more risk than lenders probably would want them to do. And so lenders have to do all they can to control that risk. So if I want to borrow money and I say, oh, it's to improve my house, but let's say I take the money and then I just invest it in cryptocurrency. I've obviously taken on more risk than the bank thought I was going to be taking on. What can be done to prevent this would be that the bank says, we want to see invoices of what you did, or we'll only give the money directly to contractors who are working on your house, right? Or we want to see pictures and we want to come to the construction site to see what's being done to your house. So that would be ways we could try to reduce the moral hazard problem. I've already said a great deal of these here. The other thing I could do here would be that I could impose some collateral. So I could say, yeah, I'll give you the money for these home repairs, but now I want to have the home be an asset that I can take away from you if you don't pay it back. And that collateral will help. Which is why car loans, for instance, are generally a bit less expensive because the car is owned by the bank while you've borrowed from the bank, and that car can be resold rather easily and rather cheaply. And you're seeing all these facts here. So these two slides here, 18 and 19, are pretty important here. I don't really want to talk about the application. The application is not usually as useful. One of the problems that we see in developing country is a lack of lending, a lack of strength of the financial system. And one of the reasons why is that it can be difficult to determine who owns something. So collateral plays an incredibly important role, for instance, in the U.S. housing mortgage market. Yet you can't use that, perhaps, in a developing country where either you don't have clearly enforceable property rights or where you don't even know who owns what. And thus, as this slide points out, it can make the system even more expensive and even more inefficient for borrowing if you don't know who owns what. Okay. So the most important thing of everything I talked about here was slides 18 and 19. But otherwise, this gives us kind of an understanding of how the financial system exists now. That it's largely indirect finance, and the reason why is because of the very strong asymmetric information that exists in the financial markets.